Hi, I'm Julie Cosgrove, and you're watching It's All About Me Helping You. And today's topic is about real estate tax strategies. During these very difficult times, we all have questions on what we should do with our properties. And so that's what I asked my good friend Stephen Groom with Stephen J. Groom CPA and Associates to come and help answer today. So Stephen, thank you so much for coming and taking your time to help work through this with me. So I guess when I'm talking to people, one of the biggest questions I ask is, should I do a short sale or a foreclosure? So with regards to taxes, what's the difference?
Well, for tax purposes, there is no difference between a short sale or foreclosure. They're treated the same. What people should be thinking about was if all of the debt was used to purchase or improve their primary residence under some qualifying rules, then up to $2 million of that debt will be excluded from being taxed on their returns thanks to the 2007 Mortgage Forgiveness Act. California has slightly lowered versions of the same rules with $800,000 of debt and $500,000 of forgiveness being forgiven on the tax returns.
Got it. So what if it's investment property?
Well, investment property does not fall under these rules, and that's a good point. If someone has investment property and they have not borrowed excess equity out of their properties, and that's a key point, because even under the mortgage forgiveness rules of a primary residence, debt that was taken out for non-real estate related reasons, finance a car, a trip, a vacation, college education, that portion may still be taxed. And it's the same with an investment property. Key difference with an investment property is at the end, it's very likely that the depreciation deductions that were taken during the holding of the property may be recaptured as income. It's also possible that there is a deduction for the amount of the original investment not yet recouped through depreciation as a capital or ordinary loss.
Okay. So that's a long answer, but it's good information. So another question that I get asked a lot is, how much am I going to be taxed?
Well, my suggestion is for everybody facing this possibility to consult a tax professional.
Absolutely.
And do a projection. There are other things that may impact their own returns. For instance, do they have losses carrying forward from prior years which they've been unable to use? Do they have a reduction of income for some unexplained reason, a loss of a job, large capital outlay for legal fees? There are some other things that may impact their return, and every situation will be different.
Everybody's different, yeah. And that's what I try and tell people, when I'm talking to people. What happens if, and this word has come up a lot, and so maybe you can help explain this, and if they have an insolvency. So can you kind of explain that?
Exactly. There is another Code Section 108 which deals with any excess canceled debt which is not excluded under one of the provisions we've already discussed, that debt may be excluded either through a bankruptcy proceeding or through an insolvency calculation. And if someone uses Code Section 108 to claim insolvency, they must attach to their return a listing of all their assets and liabilities, and if their liabilities exceed their assets, then they are technically insolvent, and to the extent of that insolvency, the amount of the insolvency, they may be able to exclude the debt that otherwise wasn't canceled under one of the remaining provisions.
Right. I think one thing that's really important that we need to bring up here is that Mortgage Debt Relief Forgiveness Act. We right now, as it stands, that is supposed to go away as of...
It's scheduled to expire by the end of this year, so it's important for people to think about the timing of this. And my apologies, it's scheduled to expire by the end of 2012.
Right.
So we have another year to look at that situation. It's quite likely that Congress extends it. Depends on the amount of relief and the number of filers that are using this provision.
Right.
Remains to be seen.
So my suggestion, though, is don't wait 6 months into the year, because it takes so much time to make decisions about what you're going to do. This is not an overnight process. It could take anywhere, if you decide you're going to do a short sale even and or a foreclosure, that process could take anywhere from 2 to 6 months. So my suggestion would be, get your tax strategies and questions answered now. Get the real estate and work together with your accountant, with your attorney, with your realtor. Get those questions answered up front to make sure that you're not left behind, because who knows what our government's going to do tomorrow? None of us do. So, Stephen, is there anything that you think we need to add to this that's important that people need to know?
I think just stress, consult a tax professional and get the
Absolutely.
answers. It's a difficult subject to broach, but
Yes, absolutely.
it pays to do it sooner.
So I thank you today for watching. It's all about me helping you. My name is Julie Cosgrove. Please don't hesitate to call me at 866-485-9641 or email me at jcosgrove@kw.com, and I'll be happy to answer any of your real estate questions. I can then refer you, if you have tax questions, refer you over to Steve, and we'd be more than happy to assist you. Thank you again for watching. Steve, thank you.
Thanks, Julie.